Most people think $10,000 isn't enough to make $1 million. But what if I told you it could be? The secret is high-growth ETFs. Today I'm going to show you and John 5 high-growth buy-and-hold ETFs, each of which can turn $10,000 into $1 million portfolio. And in the end, I'll show you one of my favorite high-growth ETFs that can turn a one-time $10,000 investment into a $5 million portfolio. But first, how do you find the best high-growth long-term ETFs? One of the best and easiest ways to find the best long-term ETFs is by looking at how well these funds have done over time. The long-term performance of a fund can give you a good idea of how it might perform in the future. However, remember that past results don't necessarily guarantee future performance, but just like in sports, the best teams often keep winning, so it's a good place to start. The longer you can look at a fund's performance, the better. Ideally, you want to check how it's been doing over the past 10 years. Most brokers will show you this, and it gives you a clear sense of how the fund has weathered different market conditions. Long-term returns can help you see past the ups and downs that can happen in a single year. This can help you avoid getting too caught up in short-term trends. Sometimes people get excited about the latest trends or hot investments, but if you're looking for the best long-term ETFs, you need something that will last. That's why looking at the 10-year returns is important. It gives you a more realistic picture of the potential growth over time. But does that mean you should ignore the short-term returns? Not exactly. Here are 2 reasons why. Short-term returns can show how popular a sector or market is right now. If a fund has been doing well recently, it can help you understand if the fund is hot right now. Secondly, you can use short-term returns to guess how the fund might do next. For example, if a fund has had poor returns over the past year, it might catch up and do better soon. This is called mean reversion, which means the fund will likely return to its average long-term performance. On the other hand, if a fund has been doing really well recently, remember, it may slow down and return to its normal performance soon. So while it's important to focus on long-term performance, it's also a good idea to consider how the fund has been doing recently. If the fund has underperformed, it might be a good time to invest more. If it's been doing really well, you might want to invest more slowly by using something called dollar cost averaging. With that in mind, let's look at 5 of the best high-growth ETFs to buy and hold for the long term. We've ranked them from 5 to 1, with each fund outperforming the last, building up to the best of the best at number 1. Starting with number 5, we have ProShares Ultra Dow 30 with the ticker symbol DDM. This ETF focuses on tracking the Dow Jones Industrial Average, but with a twist. It aims to double the daily returns of the Dow 30, meaning it tries to grow faster than the average Dow 30 stock movements. This makes it a high-risk, high-reward investment for those who are willing to take on more risk in hopes of bigger rewards. This ETF offers 2 reasons to take on that risk. First, its high growth potential. The ProShares Ultra Dow 30 ETF has a high average annual return of 14.71%. This means that over time, your investment can grow much faster than a regular ETF that follows the same index. If you choose this fund, your money could increase more quickly thanks to its strategy of doubling the daily returns of the Dow 30. Second is its strong dividend growth. The ETF offers a dividend yield of 1.04%, which is on the lower side, but what makes this ETF stand out is its dividend growth rate. The dividend compound annual growth rate is an impressive 18.46%. This means that the amount of money you receive in dividends grows much faster than the other ETFs, which can be great for long-term investors. Using the investing metrics we just mentioned, let's look at how this ETF works for John's $10,000. After 1 year, his investment would grow to $11,575. After 10 years, John's investment would grow to $43,903. Give it 10 more years, and after 20 years, John's portfolio would reach $202,070. After 30 years, John's $10,000 investment would grow to $995,409, almost $1 million, and will pay roughly $25,573 in annual dividend income. In total, this ETF will add $985,409 to your investment, with $143,469 coming from dividend reinvestment and a major chunk of $841,940 from capital appreciation. Fourth on our list is the Technology Select Sector SPDR Fund with the ticker symbol XLK. This ETF is designed to track the performance of the Technology Select Sector Index, aiming to match its price and yield results before expenses. Essentially, it's focused on the technology sector of the S&P 500, giving you exposure to some of the biggest names in tech. The Technology Select Sector Index includes companies from several industries such as technology, hardware, storage and peripherals, software, communications equipment, semiconductors and semiconductor equipment, IT services, and electronic equipment, instruments, and components. This fund allows investors to take more targeted positions in the technology sector, offering a more specific approach compared to traditional investing. The companies in the index are selected based on their industry classification from a pool of companies in the S&P 500 index. By focusing on these specific industries, the Technology Select Sector SPDR Fund helps investors gain precise exposure to the technology sector within the S&P 500. As for investing metrics, it has a 0.71% dividend yield, which grows on average about 7.73% each year. This is to be expected given the growth-focused nature of the fund. Speaking of which, it has an average share price appreciation of 17.53%. So let's see how these ETF metrics do for John's $10,000. After 1 year, his investment would grow to $11,824. 10 years from now, John's investment would grow to $52,321. After 20 years, John's portfolio would reach $266,871. Give it 10 more years, and in 30 years, John's $10,000 investment would grow to $1,348,894. In total, $1,338,894 will be added to the initial $10,000 investment, with $5,905 coming from dividend reinvestment and $1,332,990 from capital appreciation. Even though these are solid returns, there are even better options to come. In the end, I'll show you one of my favorite high-growth ETFs that can turn a one-time $10,000 investment into a $5 million portfolio. Next and third on the list is Vanguard Information Technology Index Fund ETF with the ticker symbol VGT. This ETF is more or less similar to the previous one, but it's managed by Vanguard. It's a passively managed fund that aims to track the performance of the information technology sector within the U.S. stock market. The focus is on companies in electronics, computers, and related industries. VGT uses an indexing approach, which means it tries to match the performance of its benchmark index rather than trying to outperform it. The fund holds stocks of large, mid-size, and small U.S. companies within the information technology sector as classified under the Global Industry Classification Standard. The sector includes companies involved in the electronics and computer industries, as well as those manufacturing products based on the latest applied science. In terms of investment metrics, the ETF offers a dividend yield of 0.66%, growing at an average rate of 14.68% per year. Additionally, the average share price appreciation stands at an impressive 17.9%. So let's run the numbers with this ETF and see how John's $10,000 performs. Based on its metrics, after 1 year, John's $10,000 would be worth $11,856. By the 10th year, it would grow to $54,471. After 20 years, John's portfolio would be worth $292,729. By the end of 30 years, John's initial $10,000 investment would grow to $1,557,905, paying $3,368 in annual dividends. The total value added to the initial investment would be $1,547,905, split between $26,262 from dividend reinvestment and the majority portion of $1,521,643 from capital appreciation. The second best high-growth ETF on our list is the iShares Semiconductor ETF with the ticker symbol SOXX. Managed by BlackRock, this ETF is designed to track the performance of the ICE Semiconductor Index, which includes U.S.-listed companies within the semiconductor industry. It's an excellent choice for investors looking to gain targeted exposure to one of the most important and fast-growing sectors in technology. The semiconductor industry is at the heart of virtually every modern technological advancement, powering everything from smartphones and computers to electric vehicles and cutting-edge medical devices. The fund focuses primarily on the component securities within the ICE Semiconductor Index, which gives it a highly specialized and narrow focus on semiconductor companies. While it may also invest in some other assets that share similar economic characteristics, its main goal is to provide investors with the best opportunities within the semiconductor sector. The fund is considered non-diversified, which means it may invest a larger percentage of its assets in fewer securities, focusing more narrowly on the semiconductor sector with an expense ratio of 0.35%. The dividend yield on this ETF is 0.74%, and it increases by 11.45% every year on average. More importantly, the share price itself also sees an average annual rise of 19.8%. Based on these metrics, let's see how John's $10,000 investment would perform in the iShares Semiconductor ETF over time. After 1 year, John's portfolio would grow to $12,054. By the 10th year, his investment would reach $63,565. In 20 years, the portfolio would increase to $394,091. And after 30 years, John's initial investment of $10,000 would grow to an impressive $2,417,862. The total value added to John's initial investment over the 30 years would be $2,407,862. Of this total, $12,420 comes from dividend reinvestment, while $2,395,442 is attributed to capital appreciation. And now, finally, topping our list and taking the top spot is Van Eck Semiconductor ETF with the ticker symbol SMH. This passively managed ETF is designed to give investors broad exposure to the U.S. semiconductor sector. It aims to mirror the performance of the MVIS U.S.-listed Semiconductor 25 Index, which includes U.S.-listed companies in the semiconductor industry. With an expense ratio of 0.35%, this fund focuses primarily on U.S. stocks, concentrating its investments in major players within the semiconductor market. Some of the top holdings in the fund include leading companies like NVIDIA, Taiwan's semiconductor manufacturing company, Broadcom, Qualcomm, and Micron Technology. The fund's total assets are nearly $20 billion, making it one of the largest in its space. However, it is considered top-heavy. Over 2/3 of its assets are concentrated in just the top 10 holdings. This means a large portion of the fund's performance is driven by these major companies, which could be both a strength and a risk. Although this ETF provides strong exposure to the booming semiconductor sector, it's important to note that, like any investment in the stock market, it carries risk. The value of the ETF can drop suddenly due to economic conditions or shifts in the semiconductor market. As far as the numbers are concerned, the ETF offers a low 0.48% dividend yield, which grows on average by 12.99% each year. Not impressive, but this ETF is all about capital appreciation. In fact, over the past 10 years, its average share price has grown by a solid 22.89% per year. So based on these metrics, let's break down how John's initial investment of $10,000 would perform in this ETF. After 1 year, his portfolio would grow to $12,337. By the 10th year, his investment would increase to $80,583. After 20 years, his portfolio would be worth $638,731. By the 30th year, John's $10,000 investment would grow to an impressive $5,033,411. In total, the value added to John's initial investment would be $5,023,411. Of that total, $9,369 would come from dividend reinvestment, while $5,014,043 would be attributed to capital appreciation. Want more in dividends? Click the video on the screen to find out how to make $6,000 per month with only $20 per week.